All right, everybody. I wanted to do a Netflix video because today I bought Netflix for the first time. I have been following the company for a very long time. I have been studying it for several months, and I was sort of waiting for an opportunity like this where we get a nice sell-off on some fear, uncertainty, and doubt to enter. So I'm pretty excited about it. I've been actually looking for ways to diversify the portfolio away from standard tech stocks and Magnificent Seven stocks. I think Netflix is a great um, pick here, especially around $100 or less. So let's talk about it. All right, so I don't normally start with the chart, but you can see there's a almost 30% drawdown from the all-time highs. This last candle was actually a nice opportunity for people who were looking to get in. If you got in at the low, that was an additional 11% drop. So that's what made me buy into the stock. I did have to sell something to get into this, but that's fine. Um, so the big news is that Netflix is buying Warner Brothers Discovery. There's some drama about this. I love that. It's fine. They're going to be adding the Harry Potter assets, Game of Thrones, some other major shows and movies in the HBO powerhouse. You know, I think it's a massive ad. I guess I understand why the market sells off because they always love to do irrational things that make no sense to me. So here I am capitalizing on this. This should increase their cash flows substantially. So I'm totally about this. I believe this is more than 70 billion. I believe it's closer to 82 billion. They have a lot of cash flows, as you will see in a second. So I'm not super worried about it. So everybody knows what Netflix does. Recently, a couple years ago, they actually sold off because everybody said they were a dying company. They had no moat. I think they've proven that they have a massive moat. Even people who don't like Netflix don't like to cancel their subscription, and when they do, they end up just resubscribing when they launch some sort of Hallmark movie, or they might be doing some new things in sports. Let's look just looking at the top 10. Stranger Things was huge. I don't really know much about this. Frankenstein was large. The K-pop Demon Hunters was one of the largest um, movie launches of all times. Kids are obsessed with it. Wednesday's big. The Witcher was big. I don't know these. Everybody knows Kevin Hart. I don't really know this, but there's a lot of movies and shows that are extremely popular. Um, they've built a huge set of brands and names, and they continue to invest a lot of money in their content. So let's get right into it. So Stock Unlock. We're back to Stock Unlock. For some reason, this thing is not loading well, so we're going to reload it quick. We can see that Netflix is huge. It is a whopping $424 billion market cap. I like to look at free cash flow yields, only 2%, but a stock like this, I don't expect it to be very high. What I'm more interested in is the forward PE, which that's something that we're going to look at in the future. For those who do not use Stock Unlock, you can see what the company does. You can see how many employees they have. You can see the sector that they're in, the dollar that they report for currency. You can see which exchange they're marked on, and then you can actually click right into the website from here, and then you can see similar stocks and competitors on the right side. Analyst recommendations. You can see that analysts are generally fairly bullish, except for this bear case, which is interesting. So let's get right into it. This is what I'm always looking at for companies like this. So we're going to start with analyzing from 2019 forward. So you'll see a 15% growth rate on the revenue, which is huge. Rewind it all the way back in time from the dawn of this company, it's massive. And then what I also like to do is fast forward it to eliminate the negative years for the operating cash flow. I always use trailing 12 months. You can see that since they've been net positive, it's been a 54% growth rate, which is amazing. I like to use um, cash from operating activities for companies that spend a lot of money on certain things. And a good example here is if we were to um, go into, let's look at stock-based compensation. They spend a decent amount. It's actually not bad, which is awesome. And research and development, huge expense, 3.28 billion. So I really like to use operating cash flow. So you can see the cash flow from their operating activities. This is great for a lot of the Mag 7 stocks as well. It's my favorite cash flow metric in general. For people who don't want to use that, you can use free cash flow or you can use net income. Not a huge fan of net income for high growth companies because they're usually suppressing their earnings in the short term for long term investments in growth. The way you would see if they're effective at this is if you were to use a return on invested capital, you want to see a growth. Obviously, they did a huge change in 2010, but if you were to just zoom in here, so 2012 forward, they went from a 4% yield on their invested capital to 35%, which is massive. Our ROIC tells you how strong the management team is, and obviously this management team is killing it. Moving into margins, operating margin is the margin from their operating activities, and then net margin is if you were to subtract all the other expenses out of their margin. This is great. Look at this growth. If we zoom way back, they've done just a steady, excellent job on the macro chart of growing this over time, which means, if the management team does a good job, they're actually able to use their business leverage to increase their profits while maintaining expenses either flat or preferably, as a percentage of revenues relative to their cash flows in a positive manner. I hope I didn't confuse people talking about that. But you want, like, say you're spending money on advertisements and you're spending $100 million a year. If you're always spending $100 million a year, but your margins are slowly climbing and your revenue is slowly climbing, that's a really good sign for a company. So that's something I'm also looking at. Looking at one of their KPIs, this is a newer one. You can see it since 2020. Total average paying memberships is almost 300 million. I believe they're not reporting these numbers anymore, but you can see we haven't really had a dip here in a while. You can, go into different sectors of revenue. We can look through and see a lot of the other metrics. They seem to be regionally based. Not super worried about it. Seems like they're trying to not show this anymore. And I think it's because the management team doesn't want their earnings reports to be solely focused on just that. A couple of years ago, when there was a small dip to these numbers, the market panicked. They said Netflix was dead. And then, here we are. They're not dead. They seem like a recession-proof company. And that's part of why I added them. I was able to diversify a little bit away from Magnificent Seven and base tech companies to more subscription model. Um, I believe it's a highly reliable business model, especially if they're going to be acquiring something so huge as Warner Brothers Discovery. So what I did here for the valuation is I like to take my favorite metric for the company. For this is operating cash flow. 5 years is generally what I do. And then I try to make the fair value as close to zero as possible. So let's change these numbers a little bit here. This should get us right about there. This is close enough. So this is what the market's pricing in for Netflix. If you use operating cash flow, the market is pricing in over the next 5 years an 18.5 compounded growth rate to the operating cash flows, about a 1% dilution in share buyback, sorry, negative share buybacks, no dividend. I use a normal discount rate, and then a 30 multiple. So very, 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 very bearish outlook of, a little bit over 10% or 10% right here tells you compounded annual growth rate. I'm generally shooting for 15% plus for most of my new purchases. This is very bearish. This makes absolutely no sense to me. And what's hilarious is if they actually fully acquire this Warner Brothers Discovery, these numbers really don't make any sense. Their average for their operating cash flow growth over the last 5 years is over 50%. And this multiple has been 126, which is absolutely wild. I would not want to use that multiple. So let's do something along the lines of something I would actually do. So let's give them a 45 multiple. Just the multiple expansion gives you nearly double the growth rate. And then let's be a little bit more realistic with this growth here. Let's do 28%. And you see a beautiful 28% CAGR, future stock price of 256. Absolutely insane. Let's look at net income. Net income is, growing at 30%. Price ratio is here. Let's reduce it down to 30. I like 30. And then let's go 25. Let's do 22. So 22% earnings growth with a 30 multiple for a stable business model is still giving you my goal of you're getting a double in 5 years. 15% is a double, 204. I don't like to use these accounting rule cash flow numbers or income numbers. I'm not a huge fan of that. I like the operating cash flow. So in the long and the short of this is I'm pretty bullish on this. We can look at what the analysts say. They're putting in these numbers for the EPS estimates. And again, I don't really like to use earnings, but let's go ahead and do it for fun. So the average for 2030 is 6.6. If I give a 35 multiple, 6.6 EPS, I'm getting a 231. I'm getting even higher than this. So obviously I didn't use that same number. But even if I do 6.6 times a 30, it's still almost $200. I'm not seeing how you don't outperform the market with this stock here, especially on this most recent dip we saw. That's just my feelings about this. I didn't start a huge position. I bought 100 shares, and I actually bought some calls for March to add a little leverage to the position. I would contemplate adding more shares or selling some cash secured puts here if it hovers around $100. Thanks for listening. Hope that was insightful.